Financial Reporting Through the Lens of a Property Casualty Actuary. Part 4. Statutory Filings to Accompany the Annual Statement. Introduction to Part 4. Insurance companies are required to file numerous documents with state insurance regulators each year, either included within or supplemental to the Property Casualty Annual Statement. These annual filings include those listed in the official NAIC Annual Statement Instructions Property Casualty, such as the Statement of Actuarial Opinion, SAO, Actuarial Opinion Summary Supplement, AOS, Supplemental Compensation Exhibit, Insurance Expense Exhibit, IEE, Supplemental Investment Risk Interrogatories, Financial Guarantee Insurance Exhibit, and others, such as the National Association of Insurance Commissioners, NAIC, Insurance Regulatory Information Systems, or IRIS, ratio, and Risk-Based Capital, RBC, calculation. Many of these filings serve as a means for regulators to obtain a relatively quick view of an insurance company's financial health, thereby enabling regulators to prioritize those insurance companies requiring immediate attention. The section addresses the filings that tend to be used the most by property casualty actuaries, namely the SAO, the AOS, the IEE, the RBC, and IRIS. We will discuss the purpose and important aspects of each filing. Many of these filings are addressed in considerable detail in other publications, and the NAIC has issued instructions, manuals, and/or software applications that provide the preparer of these filings with authoritative guidance. This section is not intended to replace those readings or provide instructions on how to prepare those filings. Rather, we will limit our discussion to the purpose of each and a general overview of how they are prepared. Chapter 16, Statement of Actuarial Opinion. Overview. The Statement of Actuarial Opinion, SAO, provides the opinion of a qualified actuary on the reasonableness of the loss and loss adjustment expense, or LAE, reserves recorded by a property casualty insurance company as of December 31 each year. It is filed with the annual statement, either included or attached to page 1 of the annual statement. The SAO must be prepared by a qualified actuary, as defined by the National Association of Insurance Commissioners, NAIC, who is appointed by the company's board and then referred to as the appointed actuary. Certain companies may qualify for an exemption from the SAO requirement. Possible exemptions include the following: size of insurer, less than $1 million of total gross written premiums during a calendar year, and less than $1 million of total gross loss and LAE reserves at year end. Insurers under supervision or conservatorship. Nature of business written. Insurers under financial hardship. If the cost of the SAO is greater than either 1% of surplus or 3% of gross written premiums during the calendar year within which the exemption is requested. Simply meeting one of the above criteria does not provide automatic exemption. To qualify, the insurer has to file for exemption with its domiciliary commissioner. It is at the discretion of the domiciliary commissioner to decide whether to exempt a company from the SAO requirement. The main purposes of the SAO are the following: provide the appointed actuary's opinion on the reserves specified within the scope of the SAO, inform the reader, in particular regulators, of significant risk factors and/or uncertainties with respect to those reserves, advise whether those risks and uncertainties are reasonably expected to lead to material adverse deviation in the reserves. There is considerable guidance for the actuary in issuing the SAO. Every appointed actuary should read and be familiar with the most current versions of the following: qualification standards, as set forth by the American Academy of Actuaries, AAA. NAIC instructions for the SAO. AAA Committee on Property and Liability Financial Reporting, COPLFR, Practice Note on Statements of Actuarial Opinion on Property and Casualty Loss Reserves, COPLFR P&C Practice Note. NAIC Regulatory Guidance on Property and Casualty Statutory Statements of Actuarial Opinion prepared by the NAIC's Casualty Actuarial and Statistical Task Force. Actuarial Standards of Practice, ASOPs, including but not limited to ASOP number 20, discounting of property casualty unpaid claim estimates, September 2011, ASOP number 23, data quality, ASOP number 36, statement of actuarial opinion regarding property casualty loss and LAE reserves, ASOP number 41, actuarial communications, ASOP number 43, property casualty unpaid claim estimates. Applicable state laws, in particular with respect to reserve requirements, SAO requirements, discounting, etc. The Property Casualty Loss Reserve Law Manual, published annually by the AAA, provides a compilation of this material. SSAP number 55, Unpaid Claims, Losses, and Loss Adjustment Expenses. SSAP number 62R, Property and Casualty Reinsurance. SSAP number 65, Property and Casualty Contracts. The SAO is organized into 4 required sections: identification, scope, opinion, and relevant comments. Each section must be included and clearly identified within the SAO. The SAO also contains 2 exhibits, A and B. Exhibit A provides the recorded amounts associated with the items identified in the scope section, generally on a direct plus assumed and net basis. Exhibit B provides relevant disclosure items with respect to the net reserves identified in the scope section, as identified in the relevant comments section. For example, loss and LAE reserves for asbestos are disclosed in Exhibit B on a net of reinsurance basis. There is no separate exhibit within the SAO showing asbestos reserves on a gross of reinsurance basis. Differences between the net and gross, direct plus assumed, amounts reported in Exhibit B may be discussed in the relevant comments section. While there are other publications on the CAS Exam 6 U.S. Syllabus of Basic Education that cover the SAO, there is not a real SAO on the syllabus to bring the instructions to life for the student. As a result, we have created a SAO for fictitious insurance company to illustrate the application of the SAO instructions in practice. Fictitious SAO was issued by an imaginary actuary named Mr. William H. Smith, who is a consulting actuary with the make-believe firm WS Actuarial Consulting. Smith's opinion is included in of this publication and should be read side by side with this chapter. The fictitious SAO is the author's interpretation of the NAIC instructions as they might apply to fictitious. It should not be taken as authoritative guidance on format or content of the SAO. The following provides a summarized view of each of the 4 sections of the SAO and how Fictitious's appointed actuary responded to each required section in his 2018 SAO for the company. Identification. The identification section of the SAO provides the actuary's name and credentials, the actuary's qualifications for issuing the SAO, the actuary's relationship to the company, and the date the actuary was appointed by the company's board of directors or its equivalent to issue the opinion. This section typically includes a statement identifying the intended purposes and users of the opinion, consistent with ASOP 36 requirements. For fictitious, the 2018 SAO was issued by Mr. William H. Smith, who is a fellow of the Casualty Actuarial Society and member American Academy of Actuaries, and is associated with the firm of WS Actuarial Consulting. He was appointed by the company's board of directors on September 7, 2018. At the time of issuance of his opinion, February 24, 2019, Smith met the qualification standards to issue SAOs. The intended purpose of Smith's opinion was to satisfy the requirements of the NAIC. The intended users were the company's management, the directors of its board, and state regulatory officials. Scope. The scope section identifies the reserve items upon which the actuary is giving an opinion, as well as the accounting basis for those reserves. The reserve items include loss and LAE reserves, retroactive reinsurance assumed reserves, unearned premium reserves per property and casualty long-duration contracts, unearned premium reserves for extended reporting endorsements, such as those included in Schedule P Interrogatory Number 1 of the company's annual statement, other reserve items for which the actuary is providing an opinion. The scope also identifies the review date, which is defined in ASOP 36 as the date subsequent to the valuation date through which material information known to the actuary is included in forming the reserve opinion. If no such date is explicitly disclosed, it is likely to be assumed by the reader of the opinion that the review date is the date the opinion is signed. It also contains a statement regarding who provided the data relied upon by the actuary in forming the opinion, and that either the actuary performed a reconciliation of that data or reviewed a reconciliation prepared by the company to Schedule P of the company's annual statement. If the company participates in intercompany pooling, the actuary may wish to disclose this and the basis for reconciling data used in the actuary's analysis to Schedule P. Further, regulatory guidance suggests that the scope section for each pooled company provide information about the pooling arrangement, including the intercompany pooling percentage for the company. There are special pooling requirements for opinions on non-lead companies operating under an intercompany pooling arrangement, in which the lead company retains 100% of the pooled reserves. We refer the reader to the NAIC opinion instructions and Koppel for practice note for further guidance. The reserve items on which Smith opined for fictitious are presented in Exhibit A of his 2018 SAO. As displayed on Exhibit A, Smith opined on net loss and LAE reserves in lines 1 and 2, totaling $51,557,000, as of December 31, 2018. The amounts in lines 1 and 2 of Exhibit A reconcile to lines 1 and 3, respectively, of the liabilities, surplus, and other funds page of the 2018 annual statements. Smith also opined on total direct plus assumed or gross loss and LAE reserves of $61,699,000, as shown in lines 3 and 4. The amounts in lines 3 and 4 reconcile to Schedule P, Part 1, Summary, columns 13 plus 15, and columns 17, 19, and 21, respectively. As disclosed in the Notes to Financial Statements, see Chapter 10, Notes to Financial Statements, and displayed in Exhibit A of the SAO, fictitious did not have any retroactive reinsurance assumed as of December 31, 2018, nor were there any other loss reserve items on which Smith expressed an opinion. Smith disclosed his review date as January 28, 2019. This means that information received through January 28, 2019 was relevant to his analysis of unpaid claims and his opinion on the company's loss and LAE reserves. Information after that date, to the time he signed the opinion on February 24, 2019, see the signature line of the opinion, was not relied on by Smith in forming his opinion. The scope section also provides a statement from Smith that he reconciled the data that he relied upon for purposes of forming his opinion to Schedule P, Part 1 of fictitious's 2018 annual statement. Opinion. The opinion section provides exactly what the name says, the actuary's opinion with respect to the reserves identified in the scope section. The actuary has 5 options in terms of the type of opinion, as outlined in ASOP 36. These are: 1. Reasonable, if the recorded reserve lies within the actuary's range of reasonable unpaid claim estimates. 2. Inadequate or deficient, if the recorded reserves are below what the actuary deems to be reasonable. 3. Excessive or redundant, if the recorded reserves are above what the actuary deems to be reasonable. 4. Qualified, if the actuary is unable to issue an opinion on certain items and those items are believed to be material. 5. No opinion, if the actuary is unable to conclude on the reasonableness of the recorded reserves. Note that in accordance with ASOP 36, the actuary should disclose the minimum amount that he or she deems reasonable when issuing an inadequate or deficient opinion. Similarly, the actuary should disclose the maximum amount deemed to be reasonable when issuing an excessive or redundant opinion. The actuary is also required to state whether the recorded reserves identified in the scope section meet the requirements of the insurance laws of the state the company is domiciled in and are computed in accordance with actuarial standards. Additionally, if use was made of the work of another actuary, such as for pools or associations, for a subsidiary or for special lines of business, informing the SAO, the other actuary must be identified by name and affiliation within the opinion section. The appointed actuary cannot simply rely on another actuary's opinion. The appointed actuary needs to perform enough analysis on the other actuary's work to issue an unqualified opinion on the total reserve amounts listed in Exhibit A. A situation where the company may make use of another's work is for reserves assumed by the company for its participation in underwriting pools and associations. ASOP number 36 provides the relevant guidance, and the Koppelfer P&C practice note provides good examples of how to handle this situation in practice. The 2018 SAO for fictitious states the following. In my opinion, the amounts carried in Exhibit A on account of the items identified make a reasonable provision for all unpaid losses and loss adjustment expenses, gross and net as to reinsurance ceded, under the terms of the company's contracts and agreements, are computed in accordance with accepted standards and principles, and meet the requirements of the insurance laws of Florida. Note that Smith opined on the loss and LAE reserves in Exhibit A, items 1 through 6. These reserves include retroactive reinsurance reserve assumed, which in the case of fictitious totaled 0. Unless otherwise disclosed, the appointed actuary will generally opine on the loss and LAE reserves, including the amount of retroactive reinsurance assumed, despite the fact that the amount of retroactive reinsurance is not accounted for within lines 1 and 3 of page 3 of the annual statement under SAP. This treatment is in accordance with the NAIC instructions. Retroactive reinsurance assumed is a liability, and regulators look for assurance that this balance is reasonable. The reserves for retroactive reinsurance ceded are not separately listed on Exhibit A, and are therefore not explicitly opined on by the actuary. The absence of this reserve from Exhibit A is not because regulators don't care about the reasonableness of the balance. Rather, the reserve for retroactive reinsurance ceded is already included as a component of the gross loss and LAE reserves, which are opined on by the actuary. An overstatement or understatement of retroactive reinsurance ceded would impact gross and ceded reserves equally, and have no impact on the net reserve balance. Relevant comments. The relevant comments section provides commentary and disclosures relative to the reserves opined on to assist the reader in understanding the context and composition of those reserves. Commentary is required on the following items: the actuary's materiality standard for purposes of addressing the risk of material adverse deviation, significant risks and uncertainties that could result in material adverse deviation, the significance of items listed in Exhibit B, including anticipated net salvage and subrogation, non-tabular discounting, tabular discounting, net reserves for the company's share of voluntary and involuntary pools and associations, net reserves for asbestos and environmental liabilities, claims made extended loss and LAE reserve reported as unearned premium and as loss reserves, retroactive or financial reinsurance, uncollectible reinsurance, the results of IRIS ratios 11, 12, and 13, and explanation for exceptional values, changes in methods and assumptions from those employed in the most recent prior opinion that are deemed to have a material effect on the recorded reserve or actuary's unpaid claim estimate, unearned premium reserves for P&C long-duration contracts, net reserves for accident and health A&H long-duration contracts that the company carries on the liabilities, surplus, and other funds page as losses, loss adjustment expenses, unearned premium, or other write-in items, e.g. premium deficiency reserves, contract reserves, or AG 51 reserves. With respect to the risk of material adverse deviation, the NAIC instructions require the appointed actuary to make an explicit statement as to whether or not he or she believes there are significant risks and/or uncertainties that could result in material adverse deviation. Smith addresses the above items within the 2018 SAO for fictitious as applicable. We will not discuss each item, but rather provide further details on some to assist in reading this section of the opinion. Materiality standard. There are numerous ways an actuary can establish his or her materiality standards, and examples are provided in the Copple for Practice note. Common methods are based on a percentage of reserves, surplus, and movements in risk-based capital levels, among others. Materiality standards such as 10% of loss in LAE reserves or anywhere from 10% to 20% of surplus are commonly used. However, some actuaries establish materiality standards using a set dollar amount based on the actuary's particular knowledge of the company's operations. As an extreme example, for a company operating with limited surplus and/or under regulatory intervention, a deviation in loss in LAE reserves greater than zero might be considered material. Regardless, there is no one-size-fits-all in terms of formulaic materiality standards. The standard is based on the actuary's personal opinion as to what he or she considers material in relation to the company's reserves and surplus. Smith considered a deviation in net loss in LAE reserves of more than 1. 10% of net loss in LAE reserves, which he calculated as 10% of $51.557 million, or $5.156 million. 2. 20% of policyholder surplus, which he calculated as 20% of $31.024 million, or $6.205 million. Or 3. The reduction in surplus that would result in additional action per the NAIC RBC formula, which he calculated as the difference between the following: the company's total adjusted capital of $31.024 million, which produces an RBC ratio of 555% based on authorized control level, or ACL, RBC of 5.588 million per the 5-year historical data exhibit, adjusted capital at the next RBC level of 11.176 million, which is equal to 2 times ACL. The difference between 31.024 million and 11.176 million is 19.848 million. For purposes of establishing his materiality standard, Smith selects the smallest of the 3 balances, which in this case happens to be 10% of net loss and LAE reserves, 5.156 million. Major risk factors. Once materiality is defined, the actuary determines whether there are significant risks or uncertainties that could result in material adverse deviation in the company's loss and LAE reserve. According to the NAIC instructions to the SAO, if such risk exists, the actuary should include an explanatory paragraph to describe the major factors, combination of factors, or particular conditions underlying the risks and uncertainties that the actuary reasonably believes could result in material adverse deviation. Examples of risk factors are provided in the Copple for Practice note. Note that the actuary is not expected to list all risks that the company is exposed to. Rather, only those major risk factors that could result in the reserves developing adversely by an amount that is material relative to the actuary's materiality standard. To illustrate, Smith identifies and provides details about major risk factors that materially affect the variability of the reserves held by fictitious insurance company. The major risk factors identified are mass tort claims, so-called Chinese drywall claims, cumulative injury losses, claims from large deductible workers' compensation policies, and claims related to catastrophic weather events, including wildfires, tornadoes, and hurricanes. The uncertainty associated with these types of claims adds to the variability in the company's recorded reserves. Risk of material adverse deviation. The actuary is required to make a clear statement within the SAO as to whether or not there are significant risks or uncertainties that could result in material adverse deviation. That determination is based on the major risk factors identified by the actuary's professional opinion of the variability inherent in the unpaid claim estimates, and the actuary's materiality standard. In the case of fictitious, Smith concludes that there are significant risks that could result in the net reserve amount deviating adversely from that recorded by the company by a material amount. This conclusion was determined in part quantitatively by comparing the distance between the company's net recorded loss and LAE reserve and the high end of Smith's range to his materiality standard. As shown in the Smith's actuarial opinion summary for the company, he has developed a range of reasonable unpaid loss and LAE claim estimates on a net of reinsurance basis of $43 million to $57 million, with a point estimate of $50 million. The distance between the company's recorded reserve of $51.556 million and the high end of Smith's range is $5.443 million. Smith's materiality standard is $5.156 million, which is less than the distance between the high end of his range and the recorded reserve. This means that a deviation of 5.156 is reasonably expected by Smith, as it lies within his range relative to the recorded balance. The compilation of these figures is shown in Table 57. Stated differently, Smith reasonably expects that the company's carried reserve could deviate by an amount equal to the materiality standard, since the carried reserve plus the materiality standard lies within his range of reasonable unpaid claim estimates. The results of his quantitative analysis, coupled with his knowledge of the significant risks and uncertainties inherent in the company's reserves, lead Smith to conclude that there are significant risks and uncertainties that could result in material adverse deviation in the recorded reserves. It is important to note that there is no requirement for an actuary to provide a range. Even when a range is provided, the actuary may believe there are significant risks and uncertainties that could result in material adverse deviation, despite the results of the calculation described above. In other words, there may be qualitative reasons for concluding there are significant risks that could result in material adverse deviation absent quantitative reasons. For example, a company might have a significant portion of its gross loss and LAE reserves ceded to a reinsurer of relatively weak financial strength. In this case, the carried net reserve plus materiality standard might exceed the high end of the actuary's range, assuming all reinsurance was considered valid and collectible in determining the range. However, the risk that the company may not be able to recover a portion of its gross reserves due to the financial strength of one of its reinsurers may be considered significant by the actuary, and lead him or her to conclude the carried net reserves could deviate adversely by a material amount. Therefore, both qualitative and quantitative considerations should be considered in determining whether there are significant risks that could result in material adverse deviation. Remaining relevant comments. The remaining relevant comments in Smith's opinion speak to the disclosure items in Exhibit B, addressing the fact that the company anticipates salvage and subrogation in its reserves totaling $1.363 million, and discounts its reserves for certain workers' compensation and other liability claims on a tabular basis, the amount of which totals $1.365 million. According to Smith, the company does not have claims-made extended reporting endorsement loss and expense reserves, participate in any underwriting pools or associations, or write either P&C or A&H long-duration contracts. As noted, retroactive and financial reinsurance is addressed in the relevant comments section. The liability for the one retroactive reinsurance assumed contract that the company has been deemed immaterial by Smith. Finally, Smith has disclosed in his opinion that IRIS ratios 11, 12, and 13 did not produce unusual values for the company. We have confirmed this statement in our recalculation of fictitious IRIS ratios in Appendix 1 of this publication. Signature of the appointed actuary. The SAO closes with an affirmative statement that an actuarial report supporting the SAO will be provided to the company and retained for a period of 7 years at its administrative offices, and will be made available for regulatory examination if requested. The SAO is signed and dated by the actuary for delivery along with the annual statement by March 1 of the year following the annual statement date, December 31st. Note that some states require an original signature on each signed opinion, as opposed to a photocopy. The signature line includes the actuary's address, both postal and email. Smith signed the opinion on February 24, 2019. Noteworthy changes to the NAIC SAO instructions in 2019. While this text contemplates the NAIC SAO instructions for 2018, there were significant changes to the NAIC SAO instructions for 2019 pertaining to the requirements for an actuary to be qualified to sign property casualty SAOs. In particular, the NAIC set the definition of a qualified actuary as a person who meets the basic education, experience, and continuing education requirements of specific qualification standards for statements of actuarial opinion. NAIC Property and Casualty Annual Statement, as set forth in the qualification standards for actuaries issuing statements of actuarial opinion in the United States, the U.S. Qualification Standards, promulgated by the American Academy of Actuaries, the Academy, and has obtained and maintains an accepted actuarial designation, and is a member of a professional actuarial association that requires adherence to the same code of professional conduct promulgated by the Academy, requires adherence to the U.S. qualification standards, and participates in the Actuarial Board for Counseling and Discipline when its members are practicing in the U.S. An exception to Parts 1 and 2 of this definition would be an actuary evaluated by the Academy's Casualty Practice Council and determined to be a qualified actuary for particular lines of business and business activities. The NAIC has defined the term accepted actuarial designation as an actuarial designation accepted as meeting or exceeding the NAIC's minimum property casualty, or P&C, actuarial education standards for a P&C appointed actuary, published on the NAIC website. The following actuarial designations, with any noted conditions, are accepted as meeting or exceeding basic education minimum standards. Fellow of the CAS, or FCAS. Condition: basic education must include Exam 6, Regulation and Financial Reporting, United States. Associate of the CAS, ACAS. Conditions: basic education must include Exam 6, Regulation and Financial Reporting, United States, and Exam 7, Estimation of Policy Liabilities, Insurance Company Valuation, and Enterprise Risk Management. Fellow of the SOA, FSA. Conditions: basic education must include completion of the General Insurance track, including the following optional exams: the United States version of the Financial and Regulatory Environment exam, and the Advanced Topics in General Insurance exam. The 2019 NAIC SAO instructions include a table of allowable exam substitutions for 1, 2, and 3 in the definition of accepted actuarial designation, given that exams have changed over time. In accordance with these changes, Exhibit B, Item 3 of the SAO, the Appointed Actuaries designation, has been modified to provide the appointed actuaries accepted actuarial designation, and the NAIC now requires the appointed actuary to provide qualification documentation to company's board of directors, including a description of how the appointed actuary meets the definition of qualified actuary and his or her experience relevant to the subject of the SAO. We refer the reader to the 2019 NAIC SAO instructions, AOWG regulatory guidance, and Koppelfer practice note for further details on these changes and new requirements for the appointed actuary.